Hey, welcome back to the podcast, everybody. Thank you for joining me. It's Through a Trader's Eyes with Karl Eggerss, and here we are on a Tuesday afternoon, and as you can see, a lot of green on the screen. Not a terribly strong day. Actually, when you look at some of the numbers advancing to declining and some of this stuff, you would think that we would have a little higher close than we did. See the Dow Jones up 25 points. I think it was up about maybe 45 or 50 right before the close, and then had a few ticks down at the close. So we finished at plus 25, not a stellar day. Transports had a pretty good day, up about 44 basis points. Utilities up on the day. NASDAQ up almost 1%. Oil, equipment, and services is kind of the risk on, came back into vogue. Things like materials, financials were up a little better today. As you can see, the XLF was up 1.65%, pretty strong day. Semiconductors had a good day. The Russell 2000 mid-caps pretty strong as an index, up 1.32%. The dollar down and interest rates up. So pretty obvious to see that it looks to me, based on the surface today, that it was more of a reversion to the mean trade, in the sense that you have all the things that were overbought coming back down, and all the things that were oversold coming back up, but not enough to get your attention to say the trend is changing. More of like just getting back in line, as if you were to veer off the road just a tad. You're not turning the car, you're just simply getting back on the road. And I think that's what the stock market did today, and you can see pretty mediocre across the board. Okay, as you can see, the S&P 500, it's been a couple of days since we have done a podcast, and you'll notice on here that the stock market really, not only did it break down pretty convincingly through the 200-day moving average, it broke out of this little trend line that I think I had drawn this last time, and it was kind of working its way in here, and we were kind of in the middle. I think last time I did a podcast, we had 3 straight down days, broke through it with that horrible jobs number on Friday, only 69,000 jobs being added. And, of course, we had this really horrible spike up in volume on the down day. So not only did we get a big down day, broke through the 200-day moving average, but we had the big spike in volume. So, obviously, for bulls, that's not what you want to see. For bears, that's exactly what you want to see. You can see that we did go down through there. It was a 90% down day. So we've had 2 of those in the last week or so, couple of weeks. And generally after you get that, you get a bounce. And we had that bounce today, again, very mediocre. And if we switch over here to the SPY, which is the same thing as the S&P 500, just the ETF, you can see I've drawn this little trend line here. And perhaps we have bounced now, and on this one, we actually closed above the 200-day moving average, whereas on the actual S&P 500, we did not. But I want to point out what we're seeing here is that you can see we're going up heavy volume on down days, and then lighter volume below average on the up days. And again, as a bull, you don't want to see that. As a bear, this thing's playing right into your hands. However, I've talked to a lot of people lately who are very bearish. And those people that are bearish, I've asked them, are you net short the market? Do you own a lot of short positions? And the answer invariably is no. And I think the reason why, and I've confirmed this with them, is that they are scared that there will be some announcement, some coordinated effort by central banks, some effort by the Fed, whatever it might be, to really pop the market one day and just rip the face off of the shorts. It seems very logical and easy to short right now, right? Because everything is rolled over. A lot of the medium-term indicators have turned down. You're getting weaker economic data to justify this downdraft. So it seems very easy the market should fall. And we know that, unfortunately, the Fed in their decision-making is influenced by what the stock market is doing, almost more so than what the economy is doing. And so with the stock market, the economy is already weak, and the stock market weakening as well, what's the level at which they step in and say, we're going to do something to help Europe, to help our own economy? What are they going to do? And I think the bears are scared that potentially they could say something that could cause the market to really rally hard. So it's scared to go long, scared to go short. And I think, to be honest, that makes sense, especially with the dollar rallying. We've obviously seen, if we look at the UUP, which is the bullish ETF on the dollar, you can see that it had a couple of down days. And overall, again, this has been a very strong uptrend, gone from 2170 or so all the way up to 23, which for a currency is a big, big move. And it only makes sense that with China slowing, and remember, we have to be concerned if China says they're slowing, how fast are they really slowing? Because a lot of people still doubt the data that they release. They don't believe it. They don't think the numbers are real. So if China says they're slowing, maybe they're slowing even more than what we're being told. So that's a concern. You're seeing other emerging markets slow as well, and their currencies fall. So money's exiting out of there. And then, of course, money is exiting very fast out of Europe. Where is it finding a home? It's finding a home in the U.S., and not only is it finding a home in the U.S., the easiest place to put that money is in the dollar. But what does a dollar pay you? Well, not much. So what's the next logical thing you do? You go and you buy treasuries, because at least you get some yield. Here's the treasuries. We broke out. Treasuries have had a big, huge advance, high volume. When you see that type of volume that we're looking at down here, this is to me, kind of a blow-off top. So I think we at least come back down to the 125 level on TLT, and then let's see if it holds at that point. But remember, this is very important that you understand that this is a game of relative strength, a game of purchasing power, and what you have seen in the last several weeks, and you've actually saw it in 2008, is when there is a crisis happening, money goes to a safe place. And the safe place still, with all our problems, is still the dollar. It's still the United States of America. When that money flows in here, for those on TV that say, how can interest rates, on a 10-year treasury be at 1.56%? That doesn't make any sense. It's got to go back up. Think about this. When things are going down drastically around you, the price of oil, the price of stocks, the price of real estate, whatever it might be, just getting your principal back means you're making money. On top of that, you're getting a 1.5% yield. That is why money continues to pour into treasuries. Yes, part of that money was the Fed keeping rates low, but now the market is doing it for them. There's so much money coming in this country, I think, from other countries and other investors around the world. You're seeing it continue to go up. Remember, back in 2008, during the financial crisis, for about a week or so, 3-month treasuries went negative. And everybody at the time was saying, how can that be? I'm going to buy a bond, pay the government to hold my money. That makes no sense. It made sense because everything around you was going down faster in value. It's a game of relativity, and that's what was happening, was things were going on faster. I can still have more purchasing power giving my money to the government, paying them a little bit at the end of the day, than by keeping it in something else. And that's what has been happening, and it's been happening here lately. Now, we're not negative, but we're at historically low interest rates. And that's going to probably continue for a while as the fear continues. So that's how interest rates continue to fall. Now, back to the S&P 500, we obviously have had, the break of the 200-day moving average. That is something that has to be regained. And the bounce that we got that I was looking for, and I was looking for a bounce in this area. Remember, we talked about covering shorts at this point, and we did get the bounce, but it didn't last very long, and it kind of ran into trouble at the 20-day moving average, and down we went. Now, what you see is we're going to go back up to this trend line. We've got this in place, and perhaps we go back up to here, which would be about 1,300 or so before we head back down again. And I do think we will head back down again. I'm hesitant to short the market right now because of the low volatile positions that I own in general. There are a few positions that are more for trading and short term that are a little more volatile, but in the big picture of my overall allocation of what I own things like REITs, which had a very good day, utilities, some healthcare, a lot of cash. Those are things that are okay right now. Are they going down? Yeah, but not like the market is. And so having a lot of cash has enabled me not to have to feel like I have to run out and short after the market has already fallen. We want to short when the market has rallied and people think the worst is over. Because I don't necessarily think it's over. And I think that the stock market, I would much rather short in an area, as we talked about last time, up in this area. This is the area I originally thought once we were going through this rally we could get to, which would be the 50-day, 100-day moving average, I think at that point, or even the 50-day as it continues to come down, I think that was a more logical place, and it still could be. Remember, I think we are one good headline away from getting a more substantial rally that can cause this market to go up 4 or 5%. And if that rally does not have any volume to it, then what we do is we obviously short, and we short heavier. But there's no doubt that the stock market has broken, and the market is now realizing that a lot of these indicators, economic indicators, are weaker. What we saw in the first quarter of 2012, we saw a lot of jawboning on TV about how good the economy was doing. And as I pointed out back then, all we were seeing at that point was that the economy was better than the estimates. The estimates were coming in, and so as when you saw the unemployment rate at, let's say, 8.2% for the estimate, and it came in at 8.1, that was celebrated. When you saw initial jobless claims at 365,000 was the estimate, and let's say it came in at 355,000, it was below what they thought, that was better. So the market was reacting to that, and it was reacting to the fact that interest rates in Europe were coming down based on things like LTRO. There was some things that were better than expected, and so at that point, the market was ratcheting up for maybe it's not Armageddon, maybe it's not this horrible scenario that we thought, it's just going to be mediocre. Well, now what you're seeing in the last few weeks is that the data all of a sudden is getting worse. It's not just mediocre, it's getting worse. When you add 69,000 jobs to the economy, that's not, we need probably 250,000 just to maintain, not to mention to actually grow. We probably need 300 or 350 to actually have a sustainable, growing, vibrant economy. 250,000 just to maintain all the people moving to this country. And so that is a horrible picture. Then you have the initial jobless claims ratcheting it up, and then you have China with their manufacturing and all their different data pieces coming out that are worse than expected. No wonder the stock market falls. And the thing is, when you look at this and you hear the S&P PE ratio is 14, that's cheap. Well, that's cheap based on that earnings growing, but also is 13 cheap? 12.5? 12.5 would be a 10% drop in the price of the stocks. What's the difference between an 11 PE, a 12, or 14 or 15? Not much, but that means the price of the stocks has fallen 10 or 12% during that time. So I think we do have more downside, and I think it's the market still, we're not seeing the type of panic that we saw last summer. I don't know if that's a positive divergence yet, that it's not spreading to everything, or is it just it hasn't happened yet. But it doesn't feel like we've had that capitulation low yet. So I'm trying not to make a bunch of moves in this market because I think you could get whipsawed if you bet against it too heavily and say the easy trade is to short after we've already fallen. You could get your face ripped off. You saw financials and materials rally today. You're seeing gold stocks rally. So I think you need to be careful in the trades you make, and really just the positions that you're keeping should be on the low beta, high yielding side, and then have plenty of cash. That's what I'm doing. But the trades that I am putting on, for the most part, those aren't working right now. There's companies coming out saying their earnings are slowing down, or they missed their sales forecasts, or just the stock market may be taking them down. But if you're not forced to sell, don't do so. But as I've mentioned several times on this podcast, if you can't sleep at night because you have way too much in stocks, you're forced to sell because the market is getting worse. It's not getting better. So that's something to be, and probably most of you that are watching this and listening to this do have a more conservative stance. And I've pretty much had that most of 2012, and because I didn't see the data getting much, much better, and it's still not. But I want to say something real quick about the long term. When we look at this market long term, it can be depressing depending on which era you lived in. Or it can be exciting depending on which era you lived in. And, bull markets and bear markets, they last a while. And many of you who have seen me speak know me in person. You've seen this picture many times where we've had this sideways market, 20s and 30s. We had an up market in the 40s and 50s into the early 60s. Finally went above 1,000. Then we went sideways until 1982 or so. Then we had a run up until the late 90s, actually 2000. And then we've been moving sideways. And when you look at this, you say, oh, I see that. Because originally, if I take all of this off, this is what you see, and you say, well, this is what's preached to me in financial media and through the mutual fund salesman and the life insurance salesman. Long term, baby. Hang in there. Well, unfortunately, what you're looking at is about a 100-year picture of the Dow Jones. So yes, if you have a 100-year time frame, you will probably do pretty well in stocks because over the long run, companies grow, the stock market moves based on those profits. However, over several years and even a couple of decades, macroeconomic events, interest rate cycles, political events, terrorism, all these things affect what the stock market's doing. And as you know, I'm still basing my forecasts are based on the fact that we have historically very low interest rates, and they'll probably rise at some point. We have tax rates that will probably rise at some point. We have a lot of regulation. We have a lot of debt. Those are all things that were tailwinds back in the 80s and 90s during this time frame. Those were all things that helped the stock market. They are now going to hurt the stock market. We have a recovery going on right now. We had a recovery in 09 and 10, but we never even got back to where we were before the 08. So it was kind of like, we were in the sixth inning of the game and they started another game over again. It looks like we have potentially could be going into another recession, and we never even fully recovered from the first one, and that's the problem. But overall, you have very distinct periods here in the long run. That's one period. That's an up period. It's a sideways period, a big bull market, and now we're going through this sideways period once again. And I think this sideways period will last. But what that means is, if it's going to be, and if you agree with me that it's going to be a sideways market, you will recognize that each one of these bars in here is a year. And because it's a year, this is a highly volatile time frame. That means there's money to be made. That means if it's a sideways market, what worked in the 60s and 70s? Renting your capital out, maneuvering, owning stocks when people are terribly depressed, selling them when they got a little excited. That's what worked. That's what worked in the 20s and 30s, and that's what has worked actually since about 2000, is buying depression, selling optimism. In a secular bull market like we had in the 80s and 90s, you just buy and hold and diversify and spread out. But I had a conversation with somebody, and I was pointing out the fact that the longer we move sideways, and this is where the optimistic view comes in, because I'm a fairly optimistic person in general, and I think that over the long run, we have to look forward to a bull market at some point. And I don't know how much longer this will last. It could last another 5 to 10 years of this sideways choppy, Dow's at 12,000, Dow's at 9,000, Dow's at 11,000, Dow's at 10, Dow's at 13, back to 9. That could last for another decade. But the longer it goes on, and the more profits that companies like Coca-Cola and IBM make, the cheaper those companies become. And what happens is, over the long run, you will get a buy and hold stock market will come back because stocks will be cheap. Remember, when you're buying stocks in 2000 and the stock market has run up for 18, 20 years, and you're buying stocks right here, your expectations must be lower. They don't as a human. As a human, psychologically, your expectations are that it's going to continue to go up forever. That's what your view is. When it's here, you're saying, look, it's gone up for so long, it's got to continue to go up. But mathematically, the odds of that happening are so slim, so they have to be diminished. Stocks are expensive. The Dow Jones is trading for an average PE of 30 at that point. The stock market's run up for 20 years. It was at 1,000. Now it's at 13,000. What a fabulous time. The expectations have to be lower going forward. So what does that mean now? What that means now is The expectations for higher returns are much better than they were then. That's the part people are missing. And the longer we go out without going up or with going down even lower, and companies continue to improve because we're investing mainly in companies, either through debt or through equity, it becomes a more compelling case that stocks will return more over the long run. That could still involve another 2008 crisis where the Dow goes down to 7,000. I don't know. What I'm pointing out is the longer we don't go up, these things move in cycles. And I think at some point the stock market will be a buy and hold place again. It may not happen for a while, but it will become that. The longer we go forward without having a bull market, one will come. And I know for those that are looking at the situation in Europe and looking at what's going on here, not only politically but fiscally, it's a pretty grim outlook, isn't it? But things do change. Things change, and I think I'm not going to build a bunker in the backyard, but I am realistic to say I'm not going to dump all my money in stocks over the long run and just hope it goes up. We're in a low rate, challenging time, but the longer this goes on, the more compelling stocks will become as an investment, and that's the bright side of what we've been going through. We've already gone through 10, 12, 13 years of a sideways market with a lot of volatility. And it's no different than the 60s and 70s as far as the stock market's concerned. But look what followed that, the 80s and 90s. Look what followed the Great Depression, the 40s and 50s. We will look forward to that once again. But we must preserve capital and prepare for the fact that it's probably not going to come tomorrow. By the way, when we look at the long-term stock market, this is a 10-year moving average of the PE ratio on the S&P 500. I'll say that again because it was a mouthful even for me to say. What you're looking at is the S&P 500. It's the PE ratio, the price to earnings. How many years of profits are people willing to pay for the stock? If a stock has an earnings of $1 per share, and they're paying $10 for the stock, that's a PE of 10. What this is showing you is in the 1960s and 70s, people were paying it got up to about 1968, a 10-year average of about 18 was the PE ratio. But look what happened during the 70s. The earnings may have been the same, but the price that they were willing to pay was going down. So they weren't paying for that growth, they weren't paying for those earnings. Then we got into 1980, and not only did the stock market go up, the earnings were doing fine, but they paid more for the same amount of earnings. So as opposed to paying 10 on a earnings PE ratio, by the end of 2 decades later, they were paying 23 was the 10-year average. So they were paying twice as much for the same amount of profits. Let me give you an example. Apple. Let's say Apple trades at $550. If somebody said today we're going to pay twice as much for Apple's same earnings, that would mean the stock would immediately trade at $1,100 tomorrow. That was the difference of going from the 1980s to the 2000s. Same amount of earnings, but they paid twice as much for them. Now, realistically, the earnings did go up and the stocks went up more than 2 times, but in a ratio, they went up 2 times as much. So they were paying more. They had more appetite for stocks. Then 2000 comes and the appetite has declined. And you can see the reason I use a 10-year moving average is it's a very slow-moving train. And we're in a process right now that started in 2000 and has continued for the last 12 years of individuals, institutions, money managers, mutual fund companies, whatever, paying less for the same amount of profits. I don't know where this will bottom. We don't have much history to deal with here. We have 50, 60 years, but when you're talking about 10-year moving averages, we don't. But could it come all the way down to 10? Sure, and that could take a while. But the point is that the profits are continuing to go up for these companies, and people aren't paying more for them. In fact, they're paying less. So at some point in the future, stocks will become a really good deal. And it'll probably be when interest rates start to rise. Because right now, people can still go and hide out in bonds. And at some point, that's going to end. And the logical place for that money to go is going to be the stock market. Instead of having interest rates at 1.5%, they start going up to 3%, and bond funds are going down in price, you're going to be looking at stocks that are yielding 4, 5, 6, 7%, haven't gone up in several years, and they're continuing to raise their dividends, they're making profits, they own real estate, and that will be the place to go. But right now, people are paying less for those earnings. And right now, it's at a little less than 17. It could continue to work its way down. So that's where we are now. It's not to say this is the current earnings. Remember, this is a 10-year moving average. So there's a big delay here. But the point is that people are paying less as we move along here. And I think that will continue for some time. And then as the ebb and flow of the market continues, there's going to be a period where stocks get too cheap, and we're going to be able to buy them, spread out, and let it go and put it on cruise control. But do not misunderstand what I'm saying. That is not today. That will come in the future. For right now, safety is the place to be. Income is the place to be. Low volatility is the place to be overall in the entire portfolio. Okay, on the docket tomorrow for United States economic releases, we have the NBA mortgage applications due out at 6 a.m. Central Time, non-farm productivity, unit labor costs, and the Fed's beige book. But more important than all of this, there was something historical that happened June 6th, and I'll even give you the year, 1972. There was one trader born, myself. I was born 40 years ago tomorrow, so I'll be turning 40. So this is my last day in my 30s. Very, very depressing. 30s was very good to me, and hopefully the 40s will be even better. But tomorrow's my birthday, so yes, thank you. Appreciate it. All right, guys, twitter.com/Karl Eggerss, eggerscapital.com for money management, Google Plus, we're on there, and of course through traderseyes.com, karleggerss.com, free subscription at the top right. Thank you for all those also that support the site and contribute to that through donations. Much appreciated. So have a wonderful evening, and we'll talk to you soon.